Ladies and gentlemen, it's a great pleasure to be here. And purtroppo il mio italiano non basta per dare la presentazione in italiano, mi dispiace. I hope you will be okay with my English. Of course, giving an international perspective is almost impossible. There's just so many countries. And so I try to give just an essence of the challenges we face in all countries, not just Europe, and some of the solutions we may choose. Let me just start with the three main challenges. We live too long. Well, this is kind of a schizophrenic statement, of course, because the young people are told not to smoke, not to drink, to exercise, and once they turn 65, all of a sudden it's a problem to live too long. So there's certainly some tension here. The second big challenge is we want more choice, but at the same time also more guarantees. So if you follow the reforms in many countries, it's clear that individuals want more control over their savings, but at the same time, they would also like to be protected in case of crisis, for instance. The third one is we face actually a trade-off between incentives and poverty prevention. The more you like to align to align the incentives with what people really do and react, the more you actually risk that the poor are not protected enough. So here are the challenges, and I think they are the same for almost all countries. But the problem is countries have a different history. And what kind of reforms will be taken depends on what kind of history a pension system had. Whether it started with a pay-as-you-go, whether it started with a funded system, whether it started with a generous system or a more lean one. We have to face that preferences and values are different, not just within a country, but between countries. I remember a discussion between Australians and Dutch people some years ago. And they had difficulty understanding each other because so much in the Netherlands is collective, which would not have been accepted to an average Australian. And the third one, I think Italy is a good example for how important it is, how well the pension reforms work depend on how well the labor market works and what the education system delivers. In terms of flexibility, in terms of mobility of workers, also between professions. Now let me just give you a brief overview of some of the aspects of pension systems around the world before I then tackle very quickly, because I don't have too much time, some of the challenges. Now here you see a table with a first to third pillar in some selected countries. And there are actually two numbers I would like to point you to. The first is the second pillar, the fully funded plans, which obviously have a much more important role in some countries like the Netherlands, Switzerland, and UK. That's because these countries started off not with a pay-as-you-go system, but already with a funded system. And then you also see that there are vast differences in third pillar savings, which is non-institutional savings, and actually higher for two reasons. The first reason is that you might not trust what the government delivers on pensions later on. You can take which country you want for that. The second reason is that it's often also a spillover from the second pillar. For instance, my own country, Switzerland, where the increase in the second pension pillar also triggered some more savings in the third pillar. Here you also see a kind of a simple typology of earnings-related pensions, and you see that even earnings-related pensions, so Italy would actually fit into the, what would be the state like France and Sweden, notional defined benefit system, defined contribution system, I'm sorry. And there is a tendency to go towards more private provision of pensions on the one hand, and more independent provision of pensions. So more choice, more market, which then also entails some other problems as well. Now, the first question you might ask yourself is, why do we need a public pension system at all? Why don't we just save for our own retirement? And obviously we have to distinguish two aspects of pensions. First, pensions are savings. That's probably what all countries do in some way, because they might overcome myopia of people. It's also kind of redistribution of savings between different groups of the population. And it also to avoid strategic behavior. I will show you an example later on. If you're sure to be provided by the state, you might not want to save optimally, because every euro you save will reduce your pension in the future. The second is, and I think it shouldn't be taken lightly, is that pensions are insurance. They insure survivors, they insure against living too long. That's the guy here in the bottom of the slide who lives up to more than 100 years. And we've seen that in the crisis, it also gives insurance against capital market risks. Some of the pension systems which were very close to markets, like in the US, saw drops in pension benefits by 20 to 30%. While countries which try to really insure capital market uncertainty had much lower drops. We still face the problems of financing these shortfalls, of course. So pensions have basically three functions. They help in life cycle planning. I've already alluded to that. They also help in intergenerational risk sharing. For those who have been less lucky, usually get a higher share of their pre-retirement income. And they also provide for I've talked about intra-general risk sharing now and redistribution, but I think one of the most important roles of public pensions is also to provide some intergenerational insurance risk sharing between generations who have been well off and others who have not been so well off. Now there is one question I leave here, and I might come back in the end if I have time. What about long-term care? If we talk about pensions, we usually talk about people who are still fit enough to enjoy the fruits of life later on, but at the end of life, usually people use quite a bit of resources to provide them with basic care. Now there's one thing I would like to point out which is often forgotten. Even if pension is an insurance, it's a strange one. We usually think of an insurance as protecting the ones who are unlucky, like in the case of health insurance. So you get higher benefits if you're sick. But with pensions, it's the other way around. We usually insure people who are lucky enough to live long enough. So there is some redistribution with pensions, if they are relatively generous, towards the well-off people, which then gives them the bad risks. If I ask my students in St. Gallen whether they think they've ever been bad risks, they would deny it. But of course they are, in terms of pension insurance. Now let me just go to some of the aspects I've already mentioned. Macroeconomic risks are an important risk in old age insurance. And it's important to see that public pensions imply contracts over several decades. You start at the age of 20, maybe even earlier to pay in. And if you're lucky enough, you get pensions until you're 100 or later. So you have a contract which lasts over 80 years. This means that very, very many risks are important. Let me just mention one: inflation. If pension benefits are not adjusted to inflation, even a small kind of price stability like inflation of 2% would reduce your real pension by almost 20% at the age of 75. But if the inflation was more likely to be 4%, as has been proposed by a famous macroeconomist lately, it would be more than a third that is lost if pensions are not adjusted to inflation. So there are obviously risks which are important, which have to be taken into account. Of course, there are the business cycles and crises, you have investment and capital market risks, and as I already said, life expectancy. There are other reasons why pensions are important. We know from research that there are quite a few behavioural anomalies in pensions. Financial illiteracy is an important one. It's very difficult to explain to people to really plan optimally over a life cycle. I think that's one aspect which also Elsa Fornero has done research on, to actually provide more information, more transparency, to increase financial literacy for people to really make their plans better than they had been before. There are endorsement effects. People follow the advice of their peers more than what they should actually do. They take default options because they're easy to handle. There's an issue in complexity. I'm not sure I would really be able to reconstruct my own pension stream, and although I'm working on pensions almost on a daily basis. And then most of us have present bias preferences that we rather kind of delay some hard decisions to the future. There is quite a lot of effort also done by Elsa Fornero, Anna Maria Lusardi, and others who are really convinced that you should try to educate people more. Up to now, the success demonstrated in the academic literature is kind of, I'd say, more or less indifferent between not telling them much and telling them much. There are also labor market prejudices that should not be taken lightly, especially in selling pension reforms to the people. Now, one prejudice is that older people take away jobs from young people. There's really no evidence for that. So the lump of labor fallacy, as it's called, has been demonstrated in so many studies. It might be true on a very short notice, but in the long run, more jobs for the elderly doesn't mean more unemployment for the young. Then it said that older people are less productive. Well, this is more difficult to see because some of the old people are really more sick, but on the other hand, they're also more reliable. And there's a very interesting study on the car factory in Germany in which Börs-Supan and Weiss find that elderly, on average, are even better workers than the young one. They are sick a little bit more often, but then also have fewer mistakes, which in the end results in a production that's at least as good as the young. And the last one, that early retirement is primarily caused by bad health. If you look around, my own country sees the rich retiring early, which shouldn't be the case. You see that people get sick once they retire, so it's a reverse causation. And actually, if you try to put everything together and try to get a relationship between early retirement and health, you don't find anything. So it's one of the prejudices that prevents retirement age from being increased. Now, let me go back to some of the challenges I mentioned before. Now, we live too long. What you see here are the life expectancy at age 65 in the Netherlands. I took two countries which I know relatively well. And you see that people not only live longer, but the forecast is also increasing. It's not just that we live longer, but every year the forecasts have to be revised in terms of even longer lives. Same thing here for Switzerland, it just goes up. And what's remarkable, with a large difference between men and women, this has narrowed down in almost all the European countries. Now, if you live too long, even if it's a good thing, it creates some unfunded liabilities as promised benefits exceed contributions. So it will be key to have a look on retirement age, which has been tackled in Italy in quite a dramatic form for females, and as I learned also for the general population, that retirement age is increasing to even further higher numbers. Now, one of the issues that have been discussed and also implemented in some countries is that retirement age should be indexed to observed life expectancy, which of course makes sense because you then align contributions and benefits on the one hand, and you also kind of try to follow intergeneral equity, that all generations are treated equally. But there is a problem here, that often if you start indexing relatively early, it means that you should accumulate reserves to cover the costs to cover for the longer retirement period or for the shorter retirement period. And we've seen in the past, at least since the crisis, that many countries, many governments tap into social security reserves as soon as there are problems in the country. The latest example was Spain just a couple of weeks ago. And there's a famous quote by the economist Joseph Schumpeter, who said that rather a dog accumulates reserves of sausages than a government accumulates reserves for providing for future costs. Now, the second issue, we want more choices, but also more guarantees. Now, the relevant question that the literature asks and the public pension people, politicians around the world, is how much risk can people bear? How much risk do they want to bear because they are compensated in some way? How many guarantees should we give? How much choice? How much paternalism? Especially if there are behavioural anomalies, it's probably not a good idea to give too much choice. We need to kind of focus on choices that do not distort future allocations too much. Now, if you look at key elements of more choice, that might be that you only mandate annuitization up to a certain degree, that you give more flexibility to people who save more than to cover their basic needs, and that you encourage additional savings, as have been done in almost all European countries now. Now, of course, this gives a much better fit of individual preferences and mortality, but it also has a cost. As I said, we have behavioral reasons to doubt that this will be the optimal solution. We might have some more selection, which might be partly desired, and we might have some spillovers to other social security expenditures if poverty prevention is still in place. I'm not sure I have time to give you more details on the work that's cited here, but if you give individuals more choice and at the same time provide a basic income level in old age, you induce them to behave strategically, not to annuitize pension wealth, not to save, to retire early, and so on. And the evidence is pretty clear. If the incentives are wrong, in as much that kind of a basic social security benefit is high enough to provide for old age, people usually, especially in the middle income range, behave strategically. They do not save enough. They might retire too early. They might spend their pension wealth and not annuitize it. One thing that is pretty close to my heart and where we've also done some research, I've told you a minute ago that inflation eats away a pretty large chunk of your benefits if your benefits are not adjusted to inflation. So most economists would actually advocate that you index your pensions to inflation. But in the end, it's not as clear-cut as you might think. Maybe people do not want the flat consumption in real terms, because they might want to travel more when they're 65 and still fit, and then when they're 80, they might be happy with lower means. It's a redistribution towards the rich. We know the rich live longer. So if you index inflation, this means that you take money away from the poor and give it to the rich who live longer. So in the end, you might have a redistribution that is not wanted and especially goes in the wrong direction. Now here is a quiz for those who would like some challenge themselves. What you see here are annuitization rates in Switzerland for the last 15 years approximately, and you see basically four different patterns of annuitization rates. You see one annuitization rate that is close to 100%, so people really annuitize. You see one that's in the neighborhood of 70%, one is lower, and the fourth one is even lower. So in the meantime, you might have guessed what it could be. It's within exactly the same system, it's within exactly the same pricing. There is just one thing that is different. The pension funds in green are the ones in the DB tradition. So people are used to having their benefits in annuity streams. The second one are what I called first-degree default annuitization. So these people are in funds where they can cash out their pension wealth, but if they want to do so, they have to announce it in advance, sometimes a year before. And if they forget, they get the annuity. The dark red or brownish color is what I would call second-degree default annuitization. People receive a letter saying you can choose between an annuity or a lump sum. If you don't do anything, then you get the annuity. So they're prompted, and only if they do not react, they are annuitized. And the fourth group are people in pension funds who really have been prompted until they make an active decision. So they get letters all the time, and they don't get any benefits until they have decided what to do. So obviously behavioral factors play a huge role also in terms of more choice. Okay, now let me just skip the next section or just summarize. Once you look at the relationship with accumulated pension wealth and the rate of how people annuitize, you see a pretty striking trend that those with low amounts of money cash out and those with high amounts of money take the annuity. And we actually argue in a paper with Kim Peinenburg and Stefan Staubli. Kim is actually an assistant professor here in Bocconi, which I'm very happy to say. Find out that we can replicate individual behavior if we take into account the reinsurance provided by a means-tested benefit floor in Switzerland. So what you see in the solid line are the observed numbers. What you see in the dashed line are what we actually will predict from optimal decision, taking into account that poverty floor is pretty generous in Switzerland. And what you see in the red arrows is the effect of having a generous poverty protection in old age. So this gives a bit of a background in terms of the trade-off between incentives and poverty prevention. If you provide more to prevent poverty, you risk that especially for low and middle income people, people will really fall back to that option and behave strategically. Whether it's a good thing or a bad thing is not so easy to say. You might want to give generous protection even if you lose some money with bad incentives. Okay, I think I skipped this. Now, public pensions are obviously a reinsurance for individuals, but public pensions are also a reinsurance for pension providers. We've seen that in many countries around the globe that private pensions, private savings plans, private annuity plans, they work well, they attract lots of capital, but as soon as we are in a crisis, it's the government who has to step in. So for the government, in terms of coming up with an optimal pension plan, it needs to take into account that this fallback option exists not only for individuals, but also for pension providers. Let me just say a few words to the last trade-off I mentioned, the trade-off between incentives and poverty prevention. Most of it I've already said. I would just like to add a few things. Now, from an economist's point of view, a pure insurance, in terms of kind of a risk-adjusted longevity insurance, would always be efficient and increase social welfare. It's also true that economists would like to separate redistribution and insurance, but unfortunately, this is a lot more difficult than it seems. So, one example are married men. Now, you know probably that married men live longer than single men. So for married men, it's beneficial, for men it's beneficial to marry, which is not true for women, unfortunately. But this actually choice to be married gives you access to higher pension benefits, which are at the same time insurance and redistribution. Now, redistribution also often goes against what is actually intended by redistribution, that by living longer, the rich benefit more from a pension system than the poor. There are important studies from the US and other countries which need to be taken into account. So the challenge will be sufficient protection in old age for the needy without giving too much to the rest. Now, the last thing I would like to briefly touch on is long-term care. It's often said that we don't have a retirement problem. We have a retirement problem rather than an aging problem, which is true to some degree. You can increase retirement age, but there is still the issue that long-term care expenditures stay there. You can increase retirement age by quite a lot. The expenditures for long-term care will not diminish. On the contrary, there is some evidence that dementia, the onset of dementia, has not been increased as much as life expectancy. So on average, people spend more time in dementia than they spent, say, 20 years ago. So any pension reform should also include some provision for long-term care. And there's one idea that's circling around, that you might also integrate some self-insurance mechanism into a defined contribution system, in as much that the benefits are dependent on your health status. Now, just to illustrate how important this is, these are basically numbers of means-tested expenditures that go to long-term care in Switzerland, and you see that by the age of 95, almost half of the women have to take up these benefits due to long-term care expenditures. Now I would like to stop here with a quote you probably all know, and I think Italy has been a good example that by changing the pension system early enough, they're in a situation in which a pension system is now pretty much sustainable. And I guess for all the countries on earth, also the developing countries, it's important to tackle the reforms early enough. I thank you.